let's imagine some event happens tomorrow and you wake up on Monday and you suddenly have an announcement from the president, we're now on a gold dollar. And by the way, there's a temporary restriction on converting your old dollars to the gold dollar. Well, I think, there's clearly something which nobody, well, we don't know, and it's not published anyway. Something is going on in the gold market that I don't understand and nobody seems to understand. And there's lots of speculation and theories. But if you look at the gold deliveries in Comex, you will see that every month this year, they're at least 200% higher than the equivalent month last year.
Despite the mainstream spin, the biggest capital flow of 2025 isn't tech stocks or politically driven crypto scams, it's gold, which has been quietly fleeing London and Zurich vaults for Comex's Manhattan fortress. The excuse? Tariffs? The reality? Those in the know suspect capital controls are coming to Europe. Why? Because the war cycle is heating up on the continent's eastern flank, and history shows what happens next. Controls, confiscations, and a rush for the exits. Gold, once again, is the canary in the vault. Senior wealth manager Clive Thompson notes that gold prices have surged beyond analyst expectations from earlier company reports. He calculates that several gold mining stocks will soon have very low P/E ratios. Riding on this momentum, the Zacks Mining gold industry has climbed 39.1% year-to-date, significantly outperforming the Zacks Basic Materials sector's 6.4% rally and the S&P 500's modest 0.7% rise. Investors should consider companies like Newmont NEM, Agnico Eagle Mines AEM, Barrick Mining Corporation, Kinross Gold KGC, and Gold NGD, which are poised for growth and are backed by their strong balance sheets and expansion plans. In his analysis, Thompson believes BRICS may introduce a gold-backed digital currency, possibly led by China's hidden gold reserves. If a sudden shift to a gold standard occurs, those without gold could be severely disadvantaged. China's strategic shift toward gold accumulation reached a new milestone in March 2025, with a groundbreaking mandate requiring insurance companies to convert significant portions of their assets into physical gold. This directive represents the latest development in China's systematic approach to reducing dollar dependency while strengthening its financial resilience through precious metals ownership. Looking at a wider picture, Thompson notes a mysterious surge in physical gold deliveries on Comex, up to 700% higher this May than last year. Speculation ranges from governments to hedge funds, but the key point is that they're buying at record-high prices and haven't stopped for months. Before diving into Clive Thompson's sharp insights from his latest interview, hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
At every moment in time, almost, there's always something happening in the world where you can jump on board and take advantage of it. And the one thing which is going on is the gold price. The gold price has risen way beyond the expectations of analysts when they last reported or last reviewed company results 6 months ago, 3 months ago, whatever it was. So what this means is that the profit forecasts of the analysts for the relevant gold mining companies are lagging the likely reality of what those profits will be. So if you factor in a gold price, maybe you can still knock $500 off for fun. So factor in, let's say, $2,800 for the gold price instead of the current price, which is currently 3,200 and something. And when you put that in, and by the way, you don't have to do this yourself if you don't want to. This is another exercise where you get AI to do it for you very quickly. You will discover that the expected earnings of these companies 1 year from now, 2 years from now, 3 years from now, based on that assumption of the current gold price or even a lower gold price of the day, is higher than the analysts are currently predicting. So according to my maths, and I've worked out for a fair number of gold mining companies, there's lots of them where the price earnings ratio will next year be well below 10. And I'm talking sometimes, six to 9 levels, which is a very low price earnings ratio. It's a very cheap company. And that would be so let's assume the share prices don't rise. I mean, I think they will, though. You will then have a very low price earnings ratio in a company whose earnings are growing very fast. Does that make sense? Doesn't. Yep. So what will happen? The share price has to rise because that's what robots do. They buy companies which are cheap with rising earnings. I think what's also going on is that large countries like China and probably India as well, can see that the writing is on the wall for the present system that we have. In 1944, we had the Bretton Woods Conference, and whether this was expected by the participants or not, what actually happened was the United States said, look, we've got the most gold. Why doesn't everybody go on to forget about a gold standard, which is very inconvenient because you're moving gold across the oceans with all the risks and work and costs. Why don't we go onto a dollar standard, and we will be willing to exchange your dollars and everybody's dollars for gold on demand? So the whole world in 1944 went on to this gold standard, or rather the dollar standard, which was effectively backed by gold. And that worked perfectly up until 1971, when more and more countries were saying there's too many dollars out there compared with the gold you're holding. Let's convert our dollars back to gold. Thank you very much. And so in August 1971, Nixon closed the gold window. It's sometimes known as the Nixon shock. And from that date on, the gold price traded freely. But of course, the fact was there was already a lot more debt out there than could have ever been serviced by the gold that the United States had. And of course, the gold price then took off and has barely looked back since. So, but the trouble is, we're now at the end of the road, I think, with the current system, and it's time for a new system. And a natural new system, in my opinion, might be some sort of gold-backed system. So whether that comes out of the BRICS nations, I'm suggesting a hypothetical situation, but let's say countries like China have a lot more gold than they say they have, which is a possibility. We don't know. And the BRICS nations get together and agree that they will have a monetary system backed by gold, of which China will be the holder of gold and issue all the renminbi, and everybody can, or maybe it'd be a new currency. It'd be the BRICS currency, and everybody will change their money backwards and forwards electronically, which is far more convenient than moving the gold around. But if there's a trade imbalance, that BRICS currency can always be converted back to the gold, which is held by a central bank for the BRICS nations. This could be coming, and of course it could be coming for the United States. So what would happen? Let's imagine some event happens tomorrow, and you wake up on Monday, and you suddenly have an announcement from the president, we're now on a gold dollar. And by the way, there's a temporary restriction on converting your old dollars to the gold dollar.
Well, I mean,
so those who've got the gold will be fine, but those who don't will be scrambling around to see if they can get some, because that's the only thing you'll be allowed to spend. Well, I think, there's clearly something which we don't know, and it's not published anyway. Something is going on in the gold market that I don't understand and nobody seems to understand. There's lots of speculation and theories, but if you look at the gold deliveries in Comex, you will see that every month this year, there are at least 200% higher than the equivalent month last year. So that means each month the deliveries are 3 times what they were a year ago. This month, which is May, we're only halfway through it, the deliveries are 700% higher than May last year. So someone somewhere is taking delivery of huge quantities of 100-ounce bars. That's 330,000 a bar. Someone is taking delivery of huge quantities of physical bars, and there's been all kinds of speculations to, one, who it might be or why they might be doing it, but we still don't have an answer, and we're months into this, but those bars are disappearing into some physical vault or somewhere who might in the past have been happy rolling over the futures on Comex. They're taking delivery. Question is, who are they doing? Who is it and why? I don't have the answer. I can speculate to the heart's content and tell you all the theories, but some people say it's the US government stocking up on gold because they're going back on a gold standard. Some people say it's Canada who hasn't got any. Some people say it's Warren Buffett or Berkshire Hathaway because they've got billions and they've already made a few negative noises about the dollar and owning bonds. Some people are speculating.
Who knows?
It might be Mexico. Nobody really knows. It might be a whole bunch of hedge funds all acting in concert. But whoever it is, first of all, doesn't seem to care that they're paying all-time record prices, and they haven't stopped. It wasn't a 1 month thing. It happened in January, but now it's February, March, April, May, and it carries on.
Market expert Clive Thompson underscores past sudden currency shocks like the 1934 gold revaluation and Switzerland's 2015 peg break. He warns a similar surprise could happen today with a sudden shift to a gold-backed dollar. In that case, the old dollar might instantly lose value, creating two parallel currencies overnight. The largest proponents of returning to a gold standard include figures associated with the Austrian School of Economics, free market libertarians, and some supply-side economists. These advocates believe that anchoring currency to gold could curb inflation and promote long-term economic stability. Proponents argue that a gold standard, where the currency is tied to a fixed amount of gold, would create a more predictable monetary system, significantly reducing the risk of inflation and currency devaluation plaguing fiat currencies. When a physical commodity with intrinsic value backs money, the ability of central banks to expand the money supply becomes naturally constrained. Regarding gold confiscation, Thompson believes it's highly unlikely today. Unlike in 1933, governments no longer pay bills in gold, removing the original motive. Let's get back to the interview.
Increased by another 100%. It was the next best thing because you couldn't get your hands on gold. And then a month or two later, on the 5th of April, he basically issued this executive order saying, I order everybody to hand in their gold. You're not allowed to have gold. We're still on a gold standard, but you can't have it. So it wasn't really a gold standard at all. And then we had another overnight event. On the 31st of January 1934, they devalued the dollar on the 31st of January 1934 by nearly 50%. So, but what did they do the day before that? The day before they devalued it, they said to the government passed a law ordering the Federal Reserve to turn over all its gold in exchange for government notes at the official price of $20.67. The next day, the US government revalued the dollar at $35. And the Federal Reserve was mightily pissed off that it missed out on this huge profit, which was booked as a profit. They revalued gold at, what they did, we all say they revalued gold, but what they actually did technically was reduce the amount of gold in the dollar, because the dollar was gold. So I don't know, I remember how many grains of gold, let's say it's 40 grains, they reduced it to 20 grains or 25 grains. So basically what that meant was that the Federal Reserve had missed out on billions of dollars of profit overnight. But it wasn't just the Federal Reserve who lost out. All around the world, bankers in Paris, in London, in Zurich, who were holding some dollars, suddenly found their dollars were worth that much less. And that happened in one night. And, another example of that is when the euro dropped by, within a few seconds, 30% against the Swiss franc. I think it was about 2015. Now, actually, it was the Swiss franc which broke the peg. So Switzerland was on a peg to the euro at a fixed rate of 120. The 1 Swiss franc and 20 cents would buy you a euro. And that was a peg. And then one day, without any warning and in market hours, the Central Bank of Switzerland said, we're no longer going to support this peg. And within seconds, the euro plunged, or if you like, the Swiss franc soared, and it went from 120, 1 Swiss franc 20 to buy a euro down to about 80, 90 cents in seconds. And then it bounced around, it settled around 105, 106. But that was another example where a currency can change its value rapidly. And then, of course, let's not forget when Great Britain dropped out of the ERM, the exchange rate mechanism. So Britain was trying to become part of the euro, and it was becoming tougher and tougher because everybody knew that Britain's finances were a mess. Their debt was increasing, and they were struggling to keep the pound there was a band, I forgot what it's called, the exchange rate mechanism band or whatever, something like that. And then we had George Soros come in and start betting billions against the pound. And finally, the Bank of England gave up, and the pound plunged, I think it was 20 or 30% in a day, as they suddenly said, we're not supporting this anymore. So we can have huge currency lurches. And yes, so it could happen that overnight we suddenly find ourselves on a new gold standard where we've got two currencies operating. We've got the gold dollar and the old dollar, but the old dollar isn't going to be worth 1-to-1 against the gold dollar. I don't think a gold confiscation would make any sense unless the government has to pay its bills in gold. The reason they had the 1933 confiscation was twofold. First of all, the economy ran on gold, and the banks were being emptied because the government had too much debt. So people didn't trust the banks, they didn't trust the government, so they were withdrawing all their money in physical gold coins. So the wheels of the economy were not being greased because there was no gold in the system. It was under everybody's pillow. And the second thing was the government was paying its bills in gold and the coffers were slowly emptying, so they wouldn't have had enough gold to pay the bills. So we don't pay our bills. No government pays its bills in gold today. So why would they need your gold? So I don't think it's going to happen. I think it's unlikely.
A gold standard could potentially reduce economic instability and moderate the boom and bust cycles that have characterized modern economies by limiting governments' ability to manipulate the money supply at will. With gold quietly reshaping the global financial order, are we prepared for a world where traditional currencies lose their dominance? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.